rental activities and the associated tax attributes that are attached to those. And just stop me along the way with any questions that you have. Like Erica said, I appreciate the chance to answer the questions. Let's just start with the most basic, net rental income. Rental income is your rental revenue less your rental expenses. And generally they're going to be recorded on Schedule E. Vacation rentals can go on Schedule C's, assuming you meet the eligibility. The difference being Schedule E activities are usually passive in nature. They are limited by passive loss limitation rules. Schedule C are business activities that can give us unlimited amount of losses. Passive losses are limited under law to no more than $25,000 worth of recognition in a given year. But unfortunately, passive losses have an income cap limitation. In order to achieve that, you need $150,000 or less of income in order to have you ought to pick up the full $25,000 passive loss. As your income goes above that 150, it starts to phase out, and probably by about 160, you're picking up hardly any of that $25,000 loss. The loss, if you go above that threshold, isn't actually lost. It's just what we call suspended. It goes into a little bank account. We use it in future years to offset future revenue income, and it can also be released against a sale of that particular home. You can't release it against sale of a different home, but we can release it when we sell that specific house. We track rentals, rental by rental. The tax law doesn't want us to just aggregate all these rentals together, but if we got rental A, rental B, rental C, we want to report each one of those separately so that we can release such losses. There's exceptions to passive income. When we think passive income, we normally think long-term rentals, but we can also have active type of activities. Those active activities are going to be self-rentals. We rent to ourselves in a business. We can consider those as active rentals. The income is active, the losses are passive in a self-rental. Congress has just figured out a way to really make it inconvenient when you try to create a loss when you do a self-rental. They want those losses to be attached to passive activity. Real estate professionals, any real estate professionals, you can have an active participation in a rental instead of passive. The ability to treat as a real estate professional allows you to have unlimited losses. You're not subject to that $25,000 cap on passive losses. It's a huge, huge benefit. Under the tax code, you have to be a Schedule C activity. You cannot be an employee of a rental company. You have to have some type of business activity as the actual owner, as a partner. It has to be either Schedule E, Schedule C type of activity. Yeah, you've got to have a certain amount of hours, meet all the different thresholds. Generally, if you're a self-employed real estate agent, you pretty much automatically meet it. We've got some real estate developers that can actually meet that qualification, but unfortunately, as an employee, you just can't meet that. Use the majority of your time that you spend on different taxable activities. There's a whole set of rules. You 51%, or there's other aspects that can qualify you to reach that qualification. Yeah, that is a pretty critical one. It's an easy catch by the Internal Revenue Service. Rental activities with average rental days that are less than 7 days, those can fall on Schedule C, active activity. Rentals with 30 days or less, and you have materials, personal services that you provide. That was a little more challenging, but if you do breakfast, you do B&Bs and stuff like that, and you provide a lot of personal services, that can qualify as a Schedule C activity. When we have a rental activity, we are required underneath the law to use depreciation. We depreciate the cost of that actual real estate investment over the years, 27 and a half years for long-term rent and 39 years for short-term rentals. Short-term rentals are treated just like we would a hotel, and so we're attached to the commercial time period. In Hawaii, when we have single-family residences, pretty much the average rule is that 70-80% of the value is associated with land, 20 to 30% is actually associated with the dwelling. And unfortunately, tax law says we can only depreciate the dwelling itself. We cannot depreciate the land. A lot of our clients will call me up and their thought is, oh, I'll go buy a real estate property today. I'll have this huge write-off for this year. And sadly, depreciation is just not one of those things that's going to give you a huge write-off. 27 and a half years on 20% of the purchase price usually comes out to no more than a few $1,000s of depreciation a year. Condos in Hawaii generally are completely the opposite of single-family homes. Mostly 70-80% is dwelling costs, 20 to 30% is the land value itself. How do we calculate gain on sale of our rental activity? Gain is going to be sale price, less selling expenses, less adjusted cost basis. Adjusted cost basis is going to be your original purchase price, plus any improvements, less any depreciation that you've taken over the years on that unit. Unfortunately, the Internal Revenue Code tells us that depreciation is required, but upon sale, depreciation that we have to recapture that we've taken on that unit is taxed at a higher tax rate than long-term capital gains. It's taxed at usually 25%. Long-term capital gains start out anywhere from 0% to 15% to 18.8%, all the way up to 23.8%. But the depreciation recapture always rears its kind of ugly head and is taxed at a much higher rate. Long-term, short-term, great question. Short-term is anything that's held less than 12 months. Long-term is 12 months or longer. Short-term capital gains taxed at ordinary tax rates anywhere from 10% all the way up to 37% federal. Short-term can be taxed anywhere from 5% Hawaii up to 11%. Long-term gets those more favorable rates. You can have as little as 0% long-term capital gains tax on the federal side. Generally, we're about 15 to 18.8%, and state of Hawaii, you're around 8% income tax. Yep, as long as you hold it for 12 months, and those dates count every single day of that month as an important date. When we report the sale, we have to report month and day of purchase, month and day of sale.
For 0%, is that done based on your adjusted gross income, or is that only capital gains?
0% is a loophole within the tax law. It says whatever tax, the long-term capital gains that falls within the 12% or less tax bracket. Generally, for a single individual, you're about $42,000 or less. For a married couple, maybe up to about $96,000. So if that gain falls within that $96,000 as a married couple, it's taxed at 0%. Any amount that goes above that puts you in the 22% tax bracket. It's taxed at 15%.
So just the gain, not
just the gain. Yeah, it's a loophole for long-term capital gains only. It applies to qualified dividends as well, but for our purposes, we're only thinking long-term capital gains. It's an amazing loophole that we try to take advantage in certain cases. After we account for that depreciation recapture, we're taxed at long-term capital gains on the remaining portion. I kind of threw an example here for you. So if you assume you purchase a house for $400,000, you depreciated it by $50,000, and then you turn around and you sell it for $1 million, and assuming we've got about $70,000 worth of selling costs, the gain is going to be the selling price of $1 million, less the selling expense, less our adjusted cost basis. And remember, adjusted cost basis is original purchase price plus improvements less the depreciation we've taken on it. So in this case here, our adjusted cost basis is $350,000, the $400,000 purchase price less the $50,000 worth of depreciation. And so once we calculate this out, we come up to $580,000 of gain. Remember depreciation, $50,000 of that $580,000 is depreciation under recapture, taxed at 25% federal, and then the remaining $530,000 is taxed at long-term capital gains. At that amount, you're probably looking at, there's a $600,000 cap in total income. If you keep beneath that, you're taxed at 18.8%. Above $600,000 for a married filing joint couple, you're taxed at 23.8%. So I think there's a good chance that the majority of people may hit the 18.8 with an expectation that there's probably going to be a few that are going to be taxed at 23.8 on that example. Correct. Depreciation under recapture is, in a nutshell, Congress gave you the ability to take that as a deduction every year. So every year you file your Schedule E, you included a depreciation expense. Congress says, hey, we gave you that as a deduction at ordinary income tax rates. We're going to take it back when you sell it and charge you the same ordinary income tax rates on that recapture. So what Congress gives you, they take away every ability they can. It will almost always be 25%. If you look at the Schedule D worksheet on the capital gains calculation, it calls it out to be taxed at 25%.
It used to be marginal tax, right? And then they changed it.
Yeah, let's see, this probably goes back to like 1986 where passive activity rules came into play. Now, that's the worst part when we sell a piece of real estate. One of the amazing benefits that exist out there is IRC Section 121, Internal Revenue Code Section 121. That's the bullet that gives us the ability to exclude up to $250,000 worth of capital gain when we sell real property. Of course, it comes with a lot of constraints. One of the constraints is that we have to live in that property for at least 2 of the last 5 years in order to qualify. We have to live in it as our primary house. We have an exception for military members. Military members can suspend that 5-year period up to a total of 10 years and still take Section 121. Back in about 2008, Congress came out and said they're going to start to limit the ability to use that $250,000 exclusion if your first use of that property was rental property. If you first use that property as a primary residence, you always are eligible for the full $250,000 exclusion. And that exclusion is per taxpayer. There's a tax court case probably about 10 years ago that we had multiple owners on this one property, and the tax court come out and gave their opinion that it didn't matter how many owners you had, every single owner of that property that meets the eligibility for Section 121 qualifies for that $250,000 reduction. And so if you have 10 owners, there's a $2.5 million exclusion that you can have on that property, assuming you meet the 2 out of 5 year rule. If the property was first used as a rental, now we have partial exclusion that comes into play. Back in 2008, Congress said, we're going to limit that $250,000 exclusion according to the proration of how many years that property was rented versus how many years you owned it. So the longer it's rented, the less of that exclusion that you're going to wind up with, and we prorate it. So if it was rented for 75% of the time that you owned it, you would have a reduction in that $250,000 by 75% of that, and that would be your only exclusion available to you. Today, we see a lot of folks that prefer not to have to recognize all this gain upon sale, and one of the abilities to exclude that is Section 1031 exchange. A lot of Section 1031 exchanges happen on this island, and you have the ability, assuming that you reinvest pretty much dollar for dollar the selling price versus the purchase price of the replacement property, you can defer the entire recognition of that capital gain by just doing a replacement property. You're not required to do a full replacement if you only reinvest 80% of what you sold that one property for. You can still defer up to 80% of your capital gains. And so if you look at an example here, hopefully put this in a better perspective. You purchase a house for $500,000, you depreciate it by $50,000, and then you turn around and you sell it for $1 million. Sorry, I'm on the wrong side. That example, you purchase a house for $400,000, you depreciate it by $50,000, you sell it for $1 million, and about $70,000 worth of selling expenses. If you repurchase a replacement property for $1 million, you can exclude the entire gain on that property. The selling costs help drive down how much of that purchase price has to be the replacement. So if you had $1 million sale and you had $70,000 worth of costs, you could drop all the way down to $930,000 of cost value for a replacement property and still exclude 100% of that capital gain. Not exclude, but defer. Today we see a lot of folks who have done cost segregation studies and have kind of broken out some of the costs of that original property and trying to identify some accelerated depreciation on some personal use property. This has been a kind of a sticking point for the Internal Revenue Service, but they finally come out with final regulations here not long ago that said as long as local law recognizes that cost segregation study, the items that make up that, as real property, you can include those cost segregated items as part of real property in the Section 1031 exchange. And that's a really critical component, because if you walk in and you cost segregate $300,000 or $400,000 worth of assets, the original thought was we would have to exclude all of those from a Section 1031, but because of those final regulations that came out, we can now include those costs, even though they're depreciated at a completely different basis, and we can include all of that and defer the gain of the recognition of those assets. So it is a very important and critical component, especially in today's world where so many people are going to do cost segregation studies. There's another concept that exists out there called opportunity zones. These came about in 2018 when we had the TCJA, the Tax Cut and Jobs Act of 2017. Opportunity zones gives us the ability to take our capital gains reinvest that into opportunity zones that exist across the country. And those are usually areas of the country that Congress has specifically tried to increase the value of real property in. You have to reinvest a significant amount of cash back into that property. If you do that and you hold that property for 10 years, you can sell that property and not pay a single penny of capital gains tax on that sale. It's a long-term investment. It's in certain areas of the country that you can purchase those in. The ability to get into that is pretty complicated. You can't do it as an individual. You have to do it through a corporation, through a partnership. There's a lot of restrictions on that. The big benefit of that has really expired. Back in 2018, when these first came out, you could have a reduction in the amount of capital gains tax that you paid, and you had a deferment from 2018 to the end of 2025 to actually pay the tax on that original capital gain. If you had an interest in opportunity zone, you definitely want to reach out to a qualified individual that can explain the rules to that for you. It could save you income taxes over those 10 years. You could definitely drive down the cost pretty fast on that. If I was in Nell's shoes, I would want to do that. I think that would definitely minimize the amount of taxation you'd pay in those 10-year period.
Can you explain what cost segregation is real quick?
Oh yeah, cost segregation is you go out, you spend a lot of money, but you hire some type of qualified individual to come in and identify certain assets within that property that can be depreciated much faster. Remember, depreciation on a long-term rental, 27 and a half years. Depreciation on commercial property, 39 years. That's a long time to recapture all that depreciation. Generally, in a cost segregation study, you can drive that down to 7 to 15 years worth of depreciation, significantly accelerating the expense that you can take on that.
So you save money on your taxes.
That's the whole point. Cost segregation studies give you an amazing tax deduction in those first few years, but remember then you've limited how much more depreciation you can take in the latter years.
Do you have a recommendation at what value of property you may recommend cost segregation? I've heard numbers tossed around.
What's the question?
What type of property best would fit a cost segregation study? My experience tells me that generally when you just have a single family home, you have a condo that you're renting, cost segregation could be of value, but by the time you pay $10,000 to have that study done, that's a significant hit to what you've just taken and saved in taxes. A cost segregation study for a large apartment complex or a commercial building, I think you're going to get much better results long-term in that than you are just a typical one-family house type of rental. Do you have a question, sir?
I just have a comment. So I just did one. So I'll share the numbers. I bought an apartment in Illican. It's you get Airbnb down there, right? And like we need $765,000, $263,000 cost segregation study just complete. So that's $263,000 that I didn't make this year as far as IRS.
And you just hit on a great thought there too. When you've got, I think you said you had a short-term rental that you just did that.
It is a short-term.
Yep. And so that probably came with a lot of already installed furniture and stuff like that.
Yeah, 500 square feet though. And this is actually the question I have. Is I interviewed a couple companies. Some people were $105,000 first year write-off. Some people were, I went with the highest guy, obviously at $263,000. It's an engineer. He carries the liability, right? I don't, like if the IRS audits me, like who am I? I didn't do this report. It's his
Yep.
liability, yeah?
You're exactly right. Yeah, I mean, everybody's going to look at everything differently, and I don't think in a cost segregation study, I think it would be difficult to find exact same answer across 10 individuals that did that. But you're 100% right. You're relying upon their expertise to give you that number that you can use in order to take the depreciation, the accelerated depreciation on that.
How much does your cost segregation study cost?
$3,500.
Okay.
That's actually a really good price.
But that would save me whatever my taxable basis on 250,000 is. A lot more.
As I did one for my clients on 5 units, well, it's really a single family home, but we're making split in 5, and it's like 5,500 for a cost seg study. It might be a whole legal residence, but it's a pretty good deal.
No, those are good prices. The other concept that exists with business activity is Section 199 Alpha. Section 199 Alpha is qualified business income. Generally, as a default, long-term rentals don't qualify for Section 199 Alpha. What 199 Alpha gives us is the ability to exclude, on the federal side, up to 20% of the income from taxation on that activity. Usually we see Section 199 associated with business activity. The difficulty is that the law says that rental activity has to rise to Section 162, 162 being business activity. Remember, when we first started this conversation, we talked about passive activities. By default, long-term rentals are passive in nature, not business activities. And so the Internal Revenue Service starts out with the presumption that rental activities, passive in nature, do not meet Section 162. You can reach Section 162 if you have multiple rentals. The law pretty much kind of guides us into how you can do a safe harbor if you wanted to with a Section 162 election. You literally have to document all of your hours you spend on that particular activity to meet one of the safe harbor provisions. And I can guarantee you that none of my clients are documenting every hour that they spend associated with that activity. And today it's probably a whole lot easier to do that. If you do that, you can qualify under the safe harbor provision. I'm comfortable as a tax professional that if you've got multiple rental units and that's the majority of your business, that's the majority of your income on your tax return, I would venture to say that can probably qualify for a Section 162 treatment. Your main source of income, I'm happy to elect 162 on that. Not eligible for Section 199 Alpha, no matter how much you participate in that. Mixed use rentals, you use it partially personal use, and you also rent it out. Triple net leases, Congress has decided for some reason or another triple net leases do not qualify. Self rentals and rentals that have a common owner, SST, specified service or trade business. Those are more what we refer to as a business rental type of a relationship. You own the business, you kind of rent it out to yourself. One particular issue that we see a lot of folks ask a question about is setting up an LLC to operate our rental property. My encouragement is if you can set up an LLC, especially if it relates to a rental property, it provides you protection under state law. The difficulty that we see with setting up an LLC when we have a mortgage is most mortgage companies are going to deny you the ability to actually change title of that property from your personal name into an LLC name. By doing that, they've given you this ability to no longer hold yourself personally liable for the debt of that mortgage. And most mortgage companies are going to push back pretty hard. You can, if you have fortunate enough to have the cash and you don't need a mortgage, setting up an LLC is pretty easy. The LLC gives you that protection under state law that should something happen, that you're not responsible for the debts of that lawsuit personally. Most of our clients that can't qualify for that LLC election, we always encourage them, just get yourself a nice umbrella policy that pretty well protects you. $800 to $1,000, that umbrella policy can cover multiple activities and just give you that peace of mind. Multi-member LLCs, remember, if you set up an LLC and there's more than one person, in the state of Hawaii, by default, that becomes a partnership. So even if you're husband and wife, spouse, you cannot avoid the partnership connection to that multi-member LLC. If the property is owned by an LLC, especially a multi-member LLC, we lose the ability to be able to recognize Section 121. So if we set up a multi-member LLC, put that rental property in there, we will never be able to take that $250,000 exclusion from taxation. It's permanently lost. If we have a single member LLC, taxation does not change the net result of what that net rental income will be. A single member LLC, disregarded entity, according to the Internal Revenue Service, we simply treat it as we would if we owned it in our personal name. If it's multi-member LLC, we could have a few variances. You're going to get the income reported to you on a K-1 versus filing it on your own individual income tax return.
So Brian, basically what you're saying is having an LLC is not going to save you money on your taxes with a single member for the most part. It's just liability, is that correct?
Correct. My entire interpretation of what a benefit of an LLC does is simply protect us for liability. Talk to any attorney, they'll be able to tell you the legal aspects of what an LLC protects you. Income tax wise, you shouldn't expect a single different result from that LLC versus owning that property in your individual name.
So I definitely try to impress that upon people. A lot of people think I'm going to get an LLC and put my property in the name of this LLC and I'm going to save all three on taxes. And I'm like, oh, but you're not. So don't do that.
And unfortunately, even if we have a multi-member LLC, when we receive that K-1 from that LLC, it too is going to show us that it's passive activity. If it meets the passive activity rules, there's in box 2, it's going to say net rental income. It gets the same tax treatment as we would on a Schedule E on a personal tax return. Final thing on there, we're kind of losing the ability to, on the federal side, take any type of photovoltaic credits, solar credits. The credit on the federal side expires on December 31st of this year. Unfortunately, if you haven't engaged an installer at this point, you probably are never going to make that limit, make the deadline to recognize that tax credit. On rental property, if you install a solar system, you can depreciate it over a 5-year life. But the credit itself is what we call an investment tax credit. It's severely limited to that income from that activity. So you have to have investment income in order to release any of the tax credits associated with that solar system on the federal side. So if you have a rental, you have loss, and you have no other types of investment income, you can't recognize any of that solar credit on the federal side. State of Hawaii, fortunately, doesn't treat us the same way. You can continue to recognize the solar tax credit on the Hawaii side, just like you do residential property, primary residential property. And so it's a whole lot easier on the state side. State of Hawaii has not put out any termination date for their solar credit, so even though we lose the federal credit here next month, State of Hawaii will continue to be able to utilize that credit into the foreseeable future.
You got any questions? Like, you got a lot of time.
Given the amount of increase of depreciation during the COVID period, is the IRS talking about the companies right, the 250 to 500?
heard any news yet on increasing that $250,000 yet. Any other questions?
So, for the 1031 exchange, say you didn't go over your initial sale price of the original property. You have that part, and you had, let's say, $50,000 capital. Are you able to piggyback on that 0%? You meant 96,000.
You could. You absolutely could. And that's the beneficial part. If for some reason you can hit that $50,000 and have that fall, your total taxable income less than $96,000 if you're married, you will pay 0%. That may be an opportunity that you harvest in order to, hey, I'm okay recognizing the capital gain because I'm not paying any federal income tax on it.
So you said total tax.
Right. We look at taxable income. So the taxable income rate for the 12% bracket goes all the way up to $96,000 for a joint couple. And as long as your total taxable income is at that $96,000 or less, there's 0 federal income tax on long-term capital gains.
Sorry, I thought you originally said it was just capital, but it is taxable.
Yeah. Uniquely in the tax code, capital gains are the very last thing that we recognize when we calculate income tax. Everything else is calculated first, all of our ordinary income, and then the last thing we calculate is capital gains.
Okay. Thank you.
Yes, sir.
I have military friends who put $150,000 solar on their house. No one, they moved up island, they're trying to sell it, nobody wants to buy their house because their taxable income is like $45,000. So they haven't been able to pay down the balance, right, that big tax credit. If they ultimately sell the house, do they get to carry that tax credit forward, or is that tax credit done, with whatever they take?
Yep, no, thankfully the tax credit will continue on. You can utilize that every single year into the future until it's fully gone. Sadly, the state of Hawaii has a kind of a similar type of structure. The state of Hawaii allows us to be able to elect to have a refundable tax credit as well. You can, if your income is below a certain threshold, it's really low, it's like $40,000, you can get 100% of that credit refunded to you. If your income is above $40,000, then you have to take a 30% cut in that tax credit, but you can still get it refunded to you. Under both federal and state, whatever credit you don't utilize in the current year, you just continue to carry forward to future years. And my understanding under the One Big Beautiful Bill Act is they're still allowing us to carry the solar clean energy credit forward until you fully utilize it. You just can't recognize it. Part of the OBBBA for the December 31st time period is that if your solar system is substantially installed and pretty much usable on December 31st, it may not have been inspected by city and county, you may not have everything all wrapped up, but if you can pretty much turn the switch on to be able to use that system, it will still qualify for the tax credit. The purchase of the solar systems ends on December 31st. Somehow the leasing of the solar systems gets an exception to this rule. So leasing systems those companies that lease these systems next year still are eligible for a tax credit. Somebody obviously did some heavy lobbying, and so you can still lease credits. You're not going to get the tax, or you can still lease solar systems. You're not going to get the tax credit. The leasing company gets all those tax credits. I'm going to stick around. If you have any individual one-on-one questions, just please feel free to come on up, and I'll try to answer them the best I can.
Right, thank you. So yeah, total wealth of knowledge there with Brian. Thank you so much.